Today we're going to test the famous 2-period RSI strategy developed by Larry Connors. We'll also make a couple of modifications as we go and then compare the backtest results. Now before we begin, please note that we are not financial advisors and we are definitely not your financial advisor. Nothing in this video is financial advice and shouldn't be taken as such. Everything you're about to see is for educational purposes only. Now that we have that out of the way, let's get into it. In case you're not familiar with Larry Connors, he's a professional trader who published a well-known book called Short-Term Trading Strategies That Work. Now, the centerpiece of that book is what he called the 2-period RSI strategy, which he referred to as the Holy Grail of indicators, and we're going to test that bold claim. Now, the core idea of his strategy is that when a stock is in a confirmed long-term uptrend, it typically experiences short, sharp pullbacks, and then it'll snap back quickly to resume that long-term uptrend. Not always, but often enough that it creates a statistical edge. The key word here is confirmed. The strategy isn't buying every stock that looks oversold, it's only buying stocks that have proven momentum. The oversold condition is just a temporary dip in an otherwise healthy uptrend, kind of like a rubber band that's being stretched. The strategy bets that the band is going to snap back. To get started, we'll quickly define the Relative Strength Index, or RSI for short, and then we'll move on to the strategy rules and backtest results. Once we have these baseline results in place, we'll start making modifications to both the indicator and how we test the strategy. For example, do we test it on an index or individual stocks? If it performs better on an index, then maybe we'll test it on ETFs, right? Another basket of stocks. Now, as we work through this, I'm sure you're going to have your own ideas on how to modify the strategy. So please drop your ideas in the comments section, or you can come to tradingblitz.com and put them in the forums, and I'll be sure to update these videos as we go on. The goal of these videos is to go beyond simply presenting and backtesting commonly used strategies. What I want to do is create a collaborative environment in which we can all participate in discovering the best approaches. Now, I don't claim to know all the answers, which is why your input is both welcome and necessary. Now let's quickly discuss how RSI is calculated. The standard RSI calculation uses a 14-period range, but you can change this to whatever length that you want. Now, it takes the average size of the green candles during that period and compares it to the average size of the red candles during the same period. Now, these can be daily, weekly, or 1-minute candles, depending upon whatever time frame you're using on your chart. Then this is expressed as a ratio between 0 and 100, creating what we call an oscillator. It oscillates between 0 and 100. For simplicity purposes, when we talk about RSI, we're going to be talking about it in terms of a daily chart. When the average up day is equal to the average down day, then RSI equals 50. And you can think of 50 as the neutral zone. Neither buyers nor sellers have really won the day. Neither has had a consistent edge. When RSI is above 50, the stock may be gaining momentum, and when it's below 50, the stock may be losing momentum. And finally, you'll hear people refer to key levels such as 30 and 70. Now, readings below 30 may indicate that the stock has been oversold, and readings above 70 may indicate that the stock has been overbought. Now, I use the word may. Now, let's put that in quotes, because here's the thing. Just because something looks oversold doesn't mean that it's going to bounce anytime soon. In fact, stocks that have been falling can just keep falling. And this is why we have the saying, don't try to catch a falling knife. When new traders start using RSI, how do you think they typically use it? Most new traders buy when RSI falls below 30 because that's what they've been told to do. It's now oversold, right? And then when it goes above 70, they either exit long positions or they go short because, well, it's above 70, it's overbought. However, this standard 30-70 approach tends to underperform. And the main reason it underperforms is because it lacks context. It doesn't tell you anything about the broader trend. It doesn't tell you whether the recent selling was due to profit taking in a healthy uptrend or was at the beginning of a genuine breakdown in market structure. And that's exactly what Connors figured out. And then he built a strategy around it, which is what we're going to test next. Let's start by going over the strategy's 3 rules. Then we'll test it 100 times in the Trading Blitz simulator. And then once we have the results, we'll make a few modifications and then compare the results as we go. The 3 rules are as follows. Rule 1. The stock must be above its 200-day simple moving average. The 200-day moving average is one of the most closely watched levels in all of trading. When a stock is above it, the long-term trend is considered up. When it's below, the trend is considered down. So rule number 1 acts as a filter to ensure that we're only buying stocks that are likely still in an uptrend. Rule 2. The 2-period RSI must drop below 10. Not simply below 30, but below 10. That's a significant pullback, even by short-term standards. So what we're looking for is a stock that's clearly in an uptrend, but it's just had a couple of rough days. The 2-period RSI moves fast enough to catch these short drops that a standard 14-period RSI might barely register. When both conditions are true, the stock is above the 200 SMA and the 2-period RSI has dropped below 10, that's your entry signal. We buy at the close of that candle. Rule number 3. This is the exit. We sell when the stock closes above the 5-period simple moving average, or SMA. Once the stock bounces and then closes above the 5-period SMA, we're out. The idea is straightforward. The short-term weakness that created the entry signal has resolved, and there's no reason to stay in the trade any longer. Most winning trades resolve within 1 to 5 days. It's important to note that there are no stop losses in Connor's original design. Now, while that may sound problematic, Connors tested adding stops and found that they actually hurt performance enough to remove them. Now, he gets around this by focusing on position size. Another thing worth noting is that Connors originally designed this strategy with individual stocks in mind, specifically large-cap liquid stocks that are found in the S&P universe. However, most of the widely cited backtest results that you're going to find online were run on the S&P, not individual stocks. And that distinction matters a lot. And it's something that we're going to address directly in today's tests. So the S&P has characteristics that individual stocks just don't have. First off, it's structurally mean reverting. It's a basket of 500 companies that continually gets rebalanced. Losers get replaced with winners, and it has long-term upward bias that's baked into its DNA. Whereas individual stocks can go bankrupt. They can get delisted. They enter multi-year downtrends while technically still appearing to be in an uptrend because they're still above their 200-day SMA level at the moment that you enter. So when we run this initial test, we're going to do it on 100 individual stocks, not on an index. And we should expect the results to look a little bit different than what you might see online. Maybe better with the wins, but maybe worse with losses. That difference in and of itself is a finding that's worth understanding. Now, over the years, traders have modified this strategy in various ways, either adjusting the RSI threshold from, say, 10 down to 5 or even 2, experimenting with different exit rules, or even adding volume filters. In today's test, we're going to use the original core rules as Connors published them, and then we'll see if adding our own modifications to the RSI indicator will improve the results. Here we can see what a clean setup looks like. You can see that the stock is above its 200-day SMA, so the trend is considered up. And here you can see the sharp pullback as indicated by the drop in RSI, which is now below 10. And this is our entry point at the close of this candle. Now we fast forward a few days and we can see that the price now closes above its 5-period SMA, and that's our exit. So a quick profit. Okay, let's jump into the simulator. If you're new to Trading Blitz, welcome. You've stumbled upon the Trading Blitz channel where we'll be testing trading strategies on our free stock trading simulator. The simulator allows you to practice in solo mode, which allows you to practice at your own pace, or you can enter 2-player mode and battle other traders in head-to-head matches. In these challenge matches, traders are served the same anonymous chart. You have 90 seconds to trade it. Whoever earns the most or loses the least wins the match. And speaking of competitions, we'll be launching cash prize tournaments soon. These tournaments are free to enter and will happen each time we go live on YouTube. So be sure to subscribe and hit the notification bell so you'll know exactly when we go live next. Okay, let's jump into the test. And for this test, I'm going to use chart filters, which is a premium feature on Trading Blitz, but it'll help us make the test go faster. Here you can see I've selected large cap stocks that are in a pullback pattern. This is our proprietary algorithm that identifies pullbacks in an uptrend. In other words, it ensures that the pullback happens when the stock is above the 200-period moving average. Then there's also the volume filter, but we'll leave that alone for now. Next, let's look at the indicators on the chart. These include the 5-period and 200-period simple moving averages, and I've also included the 2-period RSI at the bottom of the chart. Now each time that I click Next Chart, it'll load a randomly selected large cap stock that's in an uptrend and experiencing a pullback. Then I'll click Next Day and see if the RSI falls below 10. If it does, then I'll make a purchase. If it doesn't, I'll click Next Chart until I find one that does. For each trade, I'll use 10% of my account value, which is starting at $100,000. Once I finish, we'll review the stats. Okay, the numbers are in. Let's start with the headlines. So out of 100 trades, we earned a profit. The total gains were $43.97, which on a starting balance of $100,000 works out to about 4.4% across the test. Now, before you get too excited or too disappointed by that number, the raw dollar return really isn't the point here. What we're looking for is evidence of a statistical edge. The win rate came in at 66%, which means 66 out of the 100 trades were profitable. 2 out of every 3 trades made money. That's not a coin flip. That's a real edge. As a general rule of thumb, any win rate consistently above 50% with a positive profit factor is worth paying attention to. So what is a profit factor? This is the total amount of money that the strategy earned divided by the total amount lost, which inherently includes the win rate. So our profit factor came in at 1.27. A profit factor of 1 means that you broke even. Above 1 means that you're making more than what you're losing. And at 1.27, we earned $1.27 for every dollar that we lost. It's not spectacular, but it's positive and it's consistent. Now, here's where things get interesting. The average winning trade earned $313, whereas the average losing trade lost $478. So we're winning more often, but when we lose bigger. And that's actually to be expected in a mean reversion strategy that doesn't use a stop loss. As such, this strategy as it currently stands is counting on the high win rate to carry us through, which it did, but only barely. Another interesting stat is the average hold time. The average hold time for all trades was 10 days, but when you break it down, we see that winning trades resolved in an average of 6 days, where losing trades dragged on for an average of 16 days. Winning trades worked immediately and losing trades basically just sat there. Now, given the difference in both time and profitable versus losing trades, we might try to identify a more dynamic exit rule for future tests. When we look at the largest trades, the largest single win was $32.92, and the largest single loss was $27.53. So the best trade was only slightly better than the worst trade, which tells us that there weren't really any outlier home runs that carried the results. So the wins were steady and consistent, and the losses were also pretty fairly contained, which is a good sign. And then when we think about consistency, we might think about max consecutive wins, which were 9 in a row at one point, and then the max losses were 6 in a row. Now, if you're trading this with real money, those 6 consecutive losses would probably test your discipline. You might be down roughly $2,800 on a 10% position size before the strategy recovered. Now, that's a moment for most traders to possibly abandon the strategy right before it turns around. So position sizing is what's going to keep you in the game long term to let this edge play out with this strategy. And finally, we'll look at the annualized return, which came in at a paltry 1.56%. Now, that's pretty modest. But remember that this test was run on individual stocks and not on the index, and the famous backtest results for this strategy were run on the S&P 500, which is structurally more mean reverting. So our 66% win rate on individual large cap stocks is actually a meaningful result. And what it suggests that the core logic holds up beyond the index. Now, with that said, when testing on an index, you have a single instrument which gives you one signal at a time. With individual stocks, you could have multiple signals at a time and choose to enter many more trades, which means that your capital is working more of the time and potentially more efficiently. And as such, the annualized return from our single position test may underestimate what's possible. However, you run the risk of correlation risk, which, many large cap stocks, they move together. And if there were a broad market downturn, you might get many signals at the same time, but they all end up losing. So essentially what you have is a lot more of your capital allocated to a big downturn in the market. So for a future back test, what we might do is test entering multiple positions, but only during periods when S&P volatility is below a certain threshold, let's say. So what's the verdict on Connor's original strategy? Well, it's clear that the edge is real and the win rate is solid, but the no stop loss design means that your losses may linger longer than your wins, and the annualized return, as we saw, is pretty modest. So it's a great starting point that could give us areas for improvement that we can test in future videos. Now that we have a baseline for individual stocks, we're going to run a test for SPY, the S&P 500 ETF. And once that's complete, we'll then modify the way that RSI is calculated, and then we'll rerun these tests. Since we want to test on a specific index, and Trading Blitz feeds us random anonymized charts, I've created a custom script for TradingView, which we can use to backtest SPY. If you're not familiar with PineScript, it's TradingView's programming language, which allows you to define strategy rules via code and then automatically backtest those rules using historical data. So instead of clicking through 100 charts one at a time, the script will scan the full price history, applying the same 3 rules, and executes the trades automatically, and then generates a complete performance report. Premium members on Trading Blitz can get access to the Pine scripts that I create for these videos. So you can run the same tests yourselves, modify the parameters, and see how the results change. Now let's look at the results for SPY. For this test, I set the date range from January of 2014 through October of 2025. And this period gave us exactly 100 trades on SPY, so we'll be comparing 100 trades on individual stocks versus 100 trades on the index. Now here are the headline numbers. There were 73 profitable trades out of 100. That's a 73% win rate compared to 66% on individual stocks. The profit factor came out to 2.42, meaning that the strategy earned $2.42 for every dollar lost. Now compare that to 1.27 on individual stocks. So both win rates and profit factors are meaningful, but it's better on SPY. However, the P&L was only slightly higher for SPY at 48.80 compared to 43.97 on individual stocks. And this was the case despite the stronger statistical performance for SPY. And we already know why this is, right? So SPY moves more consistently, but the moves are smaller. So you're more consistent, but each trade provides you with a smaller profit or loss. Now, the average winning trade earned roughly $114, whereas the average losing trade lost roughly $127. And notice how close those two numbers are to each other, right? The gap for the average win versus the average loss is only $13. Now compare that to individual stocks where the gap was $165. So SPY is tighter, right? It's more predictable. It gives you a more predictable result. We also see similarities with the average hold time. For winning trades, it was only 4 days, and losing trades average 7 days. So both are shorter than what we saw with individual stocks where winners took 6 days and losers dragged on for 16 days. So the index resolves faster in both directions. And the largest single win was only 281, where the largest single loss was 413. Again, both are much smaller swings than what we saw with individual stocks where the largest win was 32.92 and the largest loss was 27.53. So again, this points to just more consistent results. And when you look at the P&L distribution chart, that pretty much told the same story. So the wins are clustered tightly around 1% and the losses are clustered around 1.3%. So no dramatic outliers in any one direction. So what's our verdict on SPY? The SPY results tell us a pretty interesting story. The higher win rate of 73% versus 66%, the profit factor of 2.42 versus 1.27, yet total P&L came out nearly identical. And so you might be wondering, how is that possible? And really what it comes down to is volatility. SPY is a basket of 500 companies, so by design, it doesn't move as dramatically as individual stocks within it. So when the strategy wins on SPY, it wins smaller, and when it loses smaller, and trades seem to resolve faster. So the bottom line is this. SPY gives you a more consistent, more predictable version of the same strategy. You're not going to hit the $3,000 winners like we saw with individual stocks, but you're also not going to sit through 2-week drawdowns wondering when the exit signal is going to come. So for traders who want lower volatility, SPY may be the better vehicle with which to execute this strategy. Now, if you're a trader who's comfortable with larger swings and you want more opportunity per trade, individual stocks may be the way to go. Neither approach is wrong, it's just they're different risk profiles using the same underlying strategy. Now that we have baseline results on both individual stocks and SPY, we're going to start modifying the strategy. Now, since this video has gotten pretty long, I think we're over 20 minutes at this point, we're going to create a part 2. And in the next video, we're going to change the way that we calculate the indicator itself. And then we'll see whether those modifications produce better results than the original RSI calculation. I think you're going to find what we discover to be pretty interesting. As we wrap up here, I just want to say thank you for any contributions that you may have made to the forums or the comment section below. I'll be sure to read through them, and if possible, I'll attempt to include your suggestions in future videos. Also, be sure to get notified of our future cash prize tournaments when we go live next by subscribing to the channel and clicking the bell icon. Again, there's no charge for these tournaments, and if you're looking to practice, you can find me on the simulator most days. My usernames are Daytrader and Chart Surfer, so I play with 2 different accounts for testing purposes. Until next time, happy and safe trading. Bye-bye.